Ladies and gentlemen, good day and welcome to Sterling and Wilson Renewable Energy Limited Q3 FY2024 earnings conference call. This conference call may contain forward-looking statements about the company which are based on beliefs, opinions and expectation of company as on date of this call. These statements are not guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need any assistance during the conference call, please signal an operator by pressing star, then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Sandeep Thomas Matthew, Head Investor Relations, for his opening comments. Thank you, and over to you, sir.
Yeah, good afternoon, everyone. Welcome to our Q3 FY24 earnings call. Along with me, I have Mr. Amit Jain, our Global CEO, Mr. Bahadur Dastoor, our CFO, and SGA, our advisors. We will start the call with the key operational highlights for the quarter and the industry outlook by Mr. Amit, followed by the financial highlights by Mr. Bahadur, post which we will open up for Q&A. Thank you, and over to you, Amit.
Thanks, Sandeep, and a warm welcome to all the participants on this call. I would like to give a quick update on our business operations and outlook on the solar industry, and I will begin with our order book. The company announced new orders and LOIs totaling approximately 2,421 crores in Q3 FY24, aided by continued ordering momentum in India and also the first large international EPC order in nearly 3 years. Coupled with our order inflow of rupees 3,106 crores announced in first half, our total order inflow, including LOIs in first 3 quarters of FY24, has now touched approximately 5,527 crore rupees. We are very excited to announce our first large international BOS order for a 221 megawatt DC project in Spain. Through this project, SWREL has achieved a key breakthrough in the European solar market. The scope of work includes design, engineering, supply, excluding PV modules and transformers, construction, erection, testing and commissioning. The total contract value, including 3 years operation and maintenance, is approximately 112 million euros. The order was backed from ENI Plenitude, which is one of the major European utilities giant with fast-growing presence in the renewable segment. In the domestic market, we achieved another breakthrough by winning a 220 megawatt DC floating solar project, which also happens to be one of the single largest floating solar blocks awarded till date in the country. The scope of the project includes module and EPC work, and the project is located in the state of Jharkhand. We have also been able to leverage the strength of our ongoing relationship by bagging another project from Sembcorp India subsidiary for a 520 megawatt DC project in Rajasthan. This also happens to be one of the largest projects of our customers in India. We are happy to be able to partner and provide customized solutions for our customers in their large projects being executed across the country. With these new orders, our unexecuted order book as on 31st December 2023 has increased to approximately 8,550 crore rupees, with nearly 97% of the order book comprising domestic EPC projects, which are executable over the next 12 to 18 months. With the inclusion of the Nigeria MOU that was announced in September 2022, our order pipeline is anticipated to enhance significantly. We are working with various stakeholders to finalize the D and EPC agreement for the project. In terms of outlook, our domestic order pipeline continues to grow very robustly, and we are expecting almost 40 gigawatt of bid pipeline to be bid out in the domestic market alone by FY25, with a major chunk anticipated to come from PSUs. The international market is beginning to gather a lot of steam, with the PO projects being bid across geographies as developers look to tap into significantly lower module prices environment. In the Middle East alone, we are seeing several gigawatt scale projects taking shape across Saudi Arabia, UAE, Oman, etc., which should be bid out in next 12 months. We are hopeful of tapping into big opportunity of mega projects subject to them matching our risk profile. In the international markets, while we have been adopting a more cautious approach with new orders, we are beginning to make headway with clients as the first order win in Europe shows. Our business development teams are working very hard and remain focused to deliver the strong growth trajectory we are targeting in this year. As stated in earlier calls, we reiterate that lumpiness in order inflow is to be expected with EPC company like ours, and timeline for achieving project closure could vary depending on a host of factors, including finalization of contractual terms, financial closure, etc. Now, moving to industry outlook, we have witnessed a significant decline in the price of module in last 12 months as per industry reports, with module price now falling to less than 13 cents per watt peak. With significant supply pressure due to emergence of new production capacities in China, industry analysts continue to anticipate module prices to remain depressed for some time. As stated in earlier calls this year, the time remains right for more projects to come up on stream, aided by lower LCOE, which should translate into more work for EPC players like us. With a strong balance sheet that has been achieved this quarter, we remain well positioned and are hopeful of achieving our targets set out earlier this year. With this, I will ask Bahadur to take you through the consolidated financial highlights. Thank you very much.
Thank you, Amit. I will start with an update on the key quarterly results. Revenue from operations for the quarter ended September was 583 crores. Revenue has improved significantly on a year-on-year basis, however, was lower sequentially due to the execution challenges we faced from tight working capital conditions seen during the course of the third quarter. The situation operationally has since improved, aided by three key factors. First, the QIP proceeds of approximately 1,500 crores in December. Second, the promoter indemnity inflows in end of November. And third, proceeds from settlement with a vendor, which was received in middle of December. The company has reported a consolidated gross margin of 11.2% in the third quarter FY24. Domestic EPC margins in the third quarter were approximately 9.5% and stand at about 10.5% for 9 months FY24. Our unexecuted order book continues to comprise approximately 87% of domestic EPC business. International EPC margins improved in third quarter FY24 primarily due to exchange gains. O&M segment margins were approximately 15% for this quarter due to certain one-off expenditures incurred post-monsoon. The company reported a second consecutive quarter of positive consolidated EBITDA in the third quarter FY24. PAT loss during the quarter was 62 crore. Now, coming to the balance sheet. As on December 31st, we had cash and cash equivalents of approximately 550 crores and our net debt stood at 27 crores and our net worth at 982 crores. In fact, if we exclude suppliers' credit of approximately 49 crores, then we had a positive net cash balance. We have repaid a large portion of our debt, including all the overdue debt, from the QIP proceeds in December itself and have earmarked deposits for upcoming debt payments. The total repayments as at date, including those with earmarked fixed deposits, is about 1,800 crore. Our working capital situation, which had tightened in Q3, has now started to improve and our projects continue to operate in a negative working capital cycle. With this, we can now open the floor to questions and answers.
Thank you very much. We will now begin question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from question queue, you may press star and 2. Participants are requested to use handsets while asking a question. We will wait for a moment while the question queue assembles. should we start the Q&A?
Yes, we can.
First question is from the line of Dhaval Doshi from Diamond Asia. Please go ahead, sir.
Hey, hi, sir. So just a few clarifications. I missed the initial comments. You mentioned 40 gigawatt of bid pipeline in the domestic, and in the international, what was the figure?
So international, it's the 15 gigawatt of pipeline is there itself in Middle East and Africa for this year, and we have roughly 8 gigawatt of pipeline in other geographies. But as we have stated in all our investor calls and speeches, that we are being very cautious with respect to taking international projects. So we are evaluating risks and margin profile before bidding and concluding any project. Though pipeline continues to remain very, very robust, and which we see the pipeline, there is sudden spurt of projects and module prices coming down. We are hoping that in coming quarter and next fiscal year, we will be receiving far more number of bids which match our risk profile and margin profile, and we'll be able to bid out far more higher numbers than we have done this year.
Okay. And the order inflow number for this quarter you said was 2,700 crores, right? Did I hear you correctly?
This quarter is 2,421 crores is the order number. And for the next quarter, there is a significant bid pipeline of 6 gigawatt. As we have said, that order booking remains lumpy based on various quarters. So next quarter itself is a huge bid pipeline, which some of the tenders bid has been already submitted, which we are awaiting for reverse auction. And a lot of bids are yet to be submitted in this quarter, which quite a few we are expecting them to conclude within this quarter.
Okay, so Q4 could actually be quite a sizable number. And
could be pretty sizable in terms of bidding if the decision happen timely. So Q4 can be a very, very good quarter.
Okay. So in terms of the timelines for the Nigeria order, I'm assuming 6 gigawatt is excluding the Nigeria project.
Yeah, so all the numbers are excluding Nigeria and Reliance projects. These are pure play like all other our third-party clients, PSU and private IPPs. So with respect to Nigeria project, we are expecting it to get concluded soon. Discussions are at very high level, are still going on, and we expect to get it concluded soon.
So do we expect something in this quarter itself, or you think this could further get delayed?
We expect that to happen within this quarter. We expect that to happen, but we are again having the ministerial level discussion there. So we'll be able to update you after those discussions. So what are the timelines we are looking at? But we are expecting it to happen very soon.
And what about Reliance, sir? When do you think the order inflows would start? And any?
So land allocation is happening now. The land allocation approval happened. Now the land allocation process is taking place. As Reliance has stated, they have very ambitious plan, and we should see the rollout on ground in coming months.
Okay. But this year, orders seems difficult. Probably Q1 is what?
No, we are not saying that looks difficult, but I don't want to put definite timeline there. But we are expecting orders this month, but orders this quarter. But I'm not putting any timeline to it. That's something in coming months we can see a rollout on the ground.
Okay. Thank you, sir. I have more questions. I'll fall back in the queue.
Thank you.
Thank you. Next question is from line of Rahul Khattarao from Grit Equities. Please go ahead.
Yeah, hi, sir. This is Rahul Kothari. Can you help us understand more on individually on the sectors like wind, where lots of traction is appearing, and also into the hybrid and battery energy storage? How Sterling is looking into it?
So we are, as you know, we are already working on hybrid projects involving batteries. So in various geographies, we are bidding for those projects, and in-house capability exists for standalone battery projects or battery projects coupled with solar. So we are fully capable of delivering those projects. So that capability exists within the organization. Now, as we have stated in our earlier investor calls, we are actively considering we are looking at wind, what format we can participate in wind POS projects. So still strategic discussions are going on how to address that particular segment of market, both with respect to EPC as well as O&M.
Okay. And sir, what about green hydrogen?
Green hydrogen, see, major projects are yet to take off the ground. Major action, whatever is happening is right now is electrolyzer manufacturing space. So whenever the substantial projects start hitting the market, so we will address that accordingly.
Okay. And sir, just one thing more regarding on the Australia front. Can we expect some tractions in the Australia since we are one of the largest player over there as well?
Yes. So there we are already received the letter for early works in one of the projects. So we are actively engaged with some of the clients, and we can expect traction with respect to standalone battery projects and the pure solar projects both in Australia and New Zealand markets.
Okay. That's it. I'll come back in a minute, sir. Thank you.
Thank you. Next question is from the line of Aegis Lakhani from Unifi Capital Private Limited. Please go ahead.
Yeah, hi, team. Congratulations on the results. Two questions here. That point number one is in the new orders that you have taken, could you guide what is the gross margin range that you have taken in domestic orders? And for the unexecuted order book that you have, what is the gross margin range that we are thinking about? That's question one.
So for the gross margins that we have taken in this quarter, it continues to fall within our domestic range of between 9 to 10%. In the case of the international project, this project is a slightly higher one. It is lower double digits. As far as our unexecuted order value is concerned, most of it being from the domestic front continues to remain in that same range which I have said earlier.
Got it. Point number two is that now, since the bulk of our debt is either repaid or is in the process of getting repaid, will the reduction in interest costs be visible from the fourth quarter, or will the full effects be visible in the first quarter?
So we had roughly 2,178 crores of debt as on September end. By end of December, we had paid out 1,600 crores out of that, and we had prepaid another 125 crores in January, which means that our debt is roughly 450 crores, of which 75 is protected by fixed deposits earmarked for that. So we have a net debt of about 377 crores, which is a substantial reduction as compared to the 2,178. Since all of this has already been accomplished by end December, early Jan, we will definitely be seeing the effects of a reduction of interest in this quarter.
Perfect. Could you also talk about, the two, events of last quarter which we had seen in your notes to accounts on the, the customer with which we had a surety bond assurance, and what is the situation on that? Because we could enforce that surety bond, but my understanding is it was delayed for some reason. So could you comment about that issue specifically?
So, with that regard, litigation is already in process. To give you a brief, so both with that particular subcontractor where the surety bond was enforced, so already there are two separate legal matters going on. One against the subcontractor which defaulted, and second with the surety company. So both there was no delay from our end. It was the delay from the end of the surety company, the company which issued the bond. And we are in litigation with that. Some of the favorable decisions have come and it is proceeding in the courts in USA. And there is an arbitration which is separately proceeding, for which the arbitration hearing will start in Q3 FY25.
Okay. And the other matter was where, two customers had invoked bank guarantees.
Yes.
I'm measuring to...
All issues. So that was our customer in USA. So it was the one customer for which we were executing two projects. And there also matter is proceeding in the local courts. One is in Washington and Oregon. So we have filed liens on the project and filed separate complaints in the local courts, and both the matters are under litigation.
Okay, so basically any resolution from that will help in incremental cash flow to the company in FY25. Is that understanding correct?
Absolutely, we have been cashed out on all those accounts. So any gain from those resolution of these issues will further add to cash flows of the company.
Perfect. And just if you could speak, with regards to the O&M business and how that is scaling up, what was the one-off that took place in, because we understood that margins are 25-30%. So could you call out what was that one-off and how do you see the O&M trends?
The one-offs were essentially a high cost of cleaning, grass cutting, etc. post-monsoon, which always happens. Plus there were other CIEG and other one-off expenses which had to be incurred as part of the compliance, which went to depress the margin. If those one-offs were excluded, the margins would have been upwards of 20%. And that is the reason for this suppression in this particular quarter.
Got it. And could you just call out how the India market is evolving today? If there is any qualitative aspect that you can call out of how the market is shaping up, what speed it is picking up, anything on that front?
Could you repeat your question, please?
Yeah, I just wanted to understand how is the India domestic market shaping up? Is there any qualitative comments you have on the shape up of the India market?
Absolutely. So India market is, I think, there is an extremely robust growth. And we see, like this year, we have addressable market of 15 gigawatts. The projects which come and which are in our range, which we are going to address and bid for that will increase from 15 gigawatts in FY24 to 24 gigawatts in FY25. So the total bid pipeline we expect in next 5 quarters is more than 40 gigawatts. So market is going to be extremely exciting, and our addressable market size is also increasing substantially. So you say 15 to 24, so there is a huge growth of 60%. We see a jump in addressable market as well. So we are very excited about Indian market going forward.
Got it. And anything on, the pledge for the principal shareholders coming down? Is there any scope for that in this year?
The pledge by the shareholders, which is essentially Shapurji Palanji, is for loans which they have taken, against which those shares have been pledged. We have no information as to whether those pledges will get reduced, because those are long-term loans. So while the expectation is they will continue to remain pledged, we do not have any definitive answer on this question.
Noted. Thanks a ton.
Thank you. Next question is from the line of Darshil Javeri from Crown Capital. Please go ahead.
Hi, good evening, sir. Hope I'm audible.
Yes, you are audible.
Yeah. Hi, sir. Thank you so much for taking my question, and it was just a wonderful commentary. So from what I could understand, the next 5 quarters we are going to be a lot bullish in terms of our order taking. So just wanted to know, next year you would be able to break even, because you would also have substantially reduced our interest cost, and we would be on track, right?
So I will start off by saying that things that are being planned right now, we do believe that this quarter itself will be a profitable one. And once this quarter is a profitable one, I think it is fair to say what will happen in the next financial year.
Oh, perfect. So that's great to hear, sir. And so our current, unexecuted pipeline of around 8,700 crores, what would be the timeline to execute that, sir?
That will be next 12 to 18 months. This order book plus whatever we book this quarter, so will be executed in next 12 to 18 months.
So that's great to hear. So I just wanted to ask a question. So in terms of our revenue recognition, we would be recognizing revenue as we complete the project or in terms of percentage completion, sir?
That's percentage completion only. So the standard way to recognize revenue for an EPC contract is percentage completion as the project progresses.
So we would be able to see uptick in terms of revenue as the quarters go by. So if that would be and what kind of OPM margins could we expect? Because if our gross margins are around 10%, what kind of operating profits, margins could we, expect going forward?
You mean EBITDA?
Yeah, EBITDA.
So it's a function of turnover. I'll just give an example. So right now our overheads, which were about 360 crores, are expected to come down significantly this year. And let's say it is somewhere between 300 to 320 crores. If you have in the next year a 10,000 crore top line, just giving an example, you will have a 10% gross margin but only a 3% overhead. So that will give you 7% EBITDA. So our overheads don't increase in line with the revenue increase. And therefore, as revenue increases in the next year, as it is expected to, we will be seeing a lot of operating leverage moving gross margin to EBITDA.
Oh, great. So that's great to know, sir. I think that answers most of my questions, sir. So all the best, sir. Thank you so much.
Thank you. Next question is from the line of Dinesh Mistry from Investor First Advisors. Please go ahead.
Hello. Thank you for taking the time out to talk to us, and congratulations on a successful QIP. I just had one question, which is that, as Bahadur, as you mentioned clearly, we are net worth positive now. We're roughly 900 crores on the shareholder fund side. And, our balance sheet is far lighter than maybe what it was even in March 19. In terms of our balance sheet now, how much of revenue do you think we can do on a simple pro rata basis? Because if I cycle back to March 19, we had done about 8,000 crores of top line with about a 8% margin. So and that time the borrowing was far higher than what it is today. So just trying to understand here, basis our balance sheet. No guidance expected, of course, but in terms of a balance sheet, how much do you think we can do on an annual basis in terms of revenues? That's it from my end.
So the essential part is what kind of non-fund limits would you have to execute the projects that you want to do? Mm-hmm. So after a lot of pressure, we are seeing normalcy returning on that front, and the company continues to work to enhance its non-fund limits. So with this present balance sheet and the non-fund limits that we have, it's safe to say what we have on hand plus some is what we can easily execute. Net worth is not really a criteria as far as getting jobs are concerned, except for bankability purposes outside India. In India, our net worth is sufficient to meet all the project requirements and prerequisites. Amit can add if I have missed anything, but it is not the net worth, but the requirement of limits, which is now seeing a massive improvement compared to what we had in the last quarter.
Got it. And just to understand, sorry, Amit, please go on. Sorry.
No, I said Bahadur has covered whatever had to be covered for your question.
And also in terms of, so right now we are in the midst of paying back our loans, but do we plan to also, because take some working capital financing, etc., or just limited to non-fund based, even in the future?
So the company does have sanctioned working capital limits, which are presently nil. It will all depend on what is the drawing power availability and whether the company needs to take anything. See, right now we have paid off all our loans. Correct. Or have parked fixed deposits such that the earliest loan repayment will start only in December 24. And that too in installments which will spread over almost 2 years. So there is no requirement that we see to borrow because we are negative working capital. All our existing projects are cash flow positive. We do not foresee any need to do any kind of incremental borrowing at this stage. However, there is working capital sanctioned limits available. If drawing power permits and there is a need, which we don't foresee though, there is a possibility we can borrow.
Okay. All right. But will it be to the extent?
No requirement to borrow at this stage. We do not foresee it happening.
You do not foresee it.
No.
Got it. And last question from my end. You've talked about loans due for the next 12 months have been paid off or funds earmarked against them. So you mentioned that we paid off roughly 1,400 crores, if I'm not mistaken, on the call. Outside of that, 1,800 crores. Yeah, exit till January, I think. So for the next year, and I'm assuming next 12 months, how much is left to be repaid to just clear it all out?
So we have, in terms of term debt, we have 328 crores of term debt, which is required to be paid post December 24. Okay. So December 24, we would have something like 29 crores. Then in the next quarter, we would have another 50 crores. And that means the entire next financial year, you don't have a number greater than 75 crores to be paid out in installments.
Got it. So that's the tranched out payment over 2 years that you're talking about.
Yes.
The 320 crore term loan.
Yes.
Okay. And this term loan was again some equipment we had bought or some...
No. It was an unsecured working capital term loan.
Which
was taken.
Got it. Great. Thank you so much, Madhu. Thank you, and wish you and Amit the very best of luck in the coming quarter. Thank you very much. Thank you.
Thank you.
Next question is from the line of Iqbal Khan from Nuvama. Please go ahead.
Yeah. Hi. So congratulations for the very good set of numbers. Just one question I have. Like you mentioned that, your order book execution timeline is 12 to 18 months. So is it possible for you to provide some kind of, revenue guidance for, say, Q4 itself? I mean, the near-term guidance I'm talking about. I think for this 9 months, you have already done around 1,700 crores of, for the 9 months, you've already done around 1,700 crores of revenue, right? So, what kind of guidance would you like to provide, or is it possible for you to provide for Q4 near term? FY25, we all see that, with this healthy order books, there is high possibility for you to turn around both at EBITDA and PAT. But can you guide us for the Q4 revenue guidance?
So I would not want to give a guidance as such, but all I can say is we will be catching up on whatever we lost in Q3, and it should be the best quarter that we will have in the year.
Oh, okay. Understood. Thank you, sir.
Thank you. The next question is from the line of Mr. VP Rajesh from Banyan Capital Advisors. Please go ahead.
Hi, thanks for the opportunity and congratulations on your GPIP. Most of my questions have been answered, but just wanted to get clarification on a couple of things. So the true-up that you did in September 23 with the promoters in terms of indemnification proceeds, has all that money come in, or is something still outstanding?
Everything has come in by the due date of it having to come in.
Okay, wonderful. And I know in the past you have given some guidance about what you expect in September 24. So if you can just update on that front, that will be helpful.
So in terms of indemnity, as things stand now, the company is still cash out somewhere between 850 to 875 crores. Some of it might get crystallized in this coming September, and the balance maybe in the September thereafter. If I were to hazard a guess, I would say somewhere around 400, max 450 crores is something that could crystallize by this September. But this is a very preliminary statement from my side, but that's more or less what it would be.
Got it. So if this number holds, then what I'm hearing is... Sorry, is it better now?
No, can you come a little closer?
Yeah, I am very close to the phone now.
Better, sir.
Thank you. So my other question is, so what I'm hearing is that given the debt position you talked about, you will be essentially a net cash company by, let's say, December quarter next year. Is that a fair way to think about this?
So if I leave out my supplier's credit, which is, a recurring thing, you will see that we are already net cash in this quarter itself. It is only because we have a supplier's credit balance of about 49 crores. That is why we became a net debt of about 27 crores. Otherwise, we were already net cash here itself. But if we get our indemnity monies, if we get our inflows from the projects, there is no reason why this loan should not be repaid. The first priority will obviously be to ensure that all project flows go to meet the requirements of the projects. If there is a surplus which we believe is there in the long term, yes, we would definitely take care and become debt-free. Net debt-free, we are almost there.
Understood. And then on the order book, you talked about 8,000 crore plus 8,500 crores, I think you said. So my question is, are all the projects negative working capital, meaning you are not going to have put any money up front into any of these projects? Is that the way to understand it?
All of these projects are negative working capital. They are all cash positive.
Okay. So then you'll be generating a lot of free cash next year if that is the situation, right? I mean, is that sort of a logical conclusion here?
Yes, your conclusion is correct.
Okay. All right. And then on the Nigeria side, if you can just elaborate, because this has been stuck for last several quarters. So what exactly is the issue that is preventing the government to, move forward over there with this project?
So as we explained in earlier calls, there is no issue which is like leading the project. The power minister had himself tweeted about the project, which you all would have seen. So its project value is so high and multiple ministries are involved. So we are just giving the final touches to with the DNDPC agreement which is to be signed, and we expect it to be get signed soon. So we are involved at the ministerial level. Discussions are going on, and we expect it to be concluded soon.
Great, wonderful. Thank you, and all the best.
Thank you. Next question is from the line of Mayank Chaturvedi from HSBC Mutual Fund. Please go ahead.
Yeah, hi. Thanks for the opportunity, sir. So just one question from my end. I joined the call a little late, so I missed your comments on the revenue execution.
We are not able to hear you clearly. Can you come closer to the mic?
Hello, is this better?
Yeah.
Yeah, I was saying I joined the call a little late, so I probably missed your comments on the revenue execution for this quarter. So if you could maybe just elaborate. I think it was expected that the NTPC order execution will pick up from the third quarter, and the revenue was expected to be much higher. So any particular reason for revenue being lower than the earlier quarter?
The revenue was lower than the earlier quarter primarily because of the difficulties which we faced when there was a rating downgrade caused by missing of an installment of a loan. That created a lot of flutter. Banks had clamped down on certain amount of limits, which made it difficult to meet the execution targets that we have. Having now done the QIP, paid off all the overdue debt, in fact paid off all debt such that you have nothing to pay till almost December of this year, we are seeing that there is a change. Discussions are on with banks to work out enhanced limits to meet the requirements of the revenue and cost for this quarter and the coming quarters. As I have mentioned, while we are not giving a guidance, we will be catching up on the revenue loss of the previous quarter in the current one, plus whatever we had anticipated to do in this current quarter.
Okay. Oh, great. So I think this lower fund-based limits would have also affected your execution up until now in January, right? And that will pick up in the rest of the months, maybe. Is that conclusion correct?
Yes, there was a bit of stress in some of the projects, but it was being managed. However, we have utilized all the cash flows not only to pay off debt, but even if there were any vendors and subcontractors which could have been paid out to increase the pace of execution of the projects.
Okay, sure. Okay, so that's all from my end.
Thank you.
Thank you. Next question is from the line of Rahul Jain from JM Financial PMS. Please go ahead.
Yeah, hi sir, I am audible?
Yes.
Little muted. Maybe if you could come a little closer, that would be helpful, Rahul.
Now this is fine?
Perfect.
Yeah. So, sir, thank you for the opportunity. I just wanted to understand that if not for the working capital challenges which we faced on the execution front in Q3, wanted to understand how much of the execution did we miss, if you can share some numbers on that side.
Let's say I'm giving a ballpark number. We would have achieved roughly 2/3 of what we would have wanted to achieve.
Okay. And sir, some bookkeeping question which I had. So in the segmental result, what is the unallocable expenditure consist of? If you can share some things on that side.
There on the first page, Rahul, it is your employee benefit expense, finance costs, depreciation and other expenses. Coming to 153 crores. Essentially, the overheads plus interest and depreciation.
Okay. This will significantly come down with interest expenses coming down. Okay.
Yes.
Yeah. Sir, thanks for the clarification. That's it from me. And all the best.
Thank you.
Thank you. Next question is from the line of Nikhil Abhyankar from ICICI Securities. Please go ahead.
Thank you, sir. Thanks for the opportunity. So the module prices in the international markets have fallen to 13-14 cents a watt. Is it also, what are the domestic prices for domestically sourced modules?
So domestic prices right now in the range of 20 to 22 cents, but with the more capacity additions happening in India, there will be a movement towards to cover the bridge between international pricing and domestic pricing. So we have to see, we expect that module prices in India also will be competitive in coming quarters.
Understood. So basically 90% of our order book is domestic, so we have to source those modules domestically. Is it the case?
Yeah, absolutely. For projects with modules which we win in India, we'll be sourcing modules from India.
Okay. So, and because of the lower interest...
Add to what Amit has said, as of right now, we have only 2 projects where there is modules. One is what we have won last with NTPC, and the other one is what we are the L1 for in a floating solar job.
So what is the total order value for these 2 orders?
Around total value will be close to 2,000 crores.
2,000 crores. Okay. And so regarding Nigeria orders, since the module prices have fallen internationally, should we expect that $1.5 billion order to reduce in size?
So right now, the agreement is getting concluded, but we have no such indications from the client side.
Okay. And just going back to your initial remarks, you mentioned that Reliance is in the process of finalizing their RE plans. So can you just throw some light on that and quantify what kind of plans these are and what is the quantum of orders?
I will not like to indicate because Reliance plans are in public domain. We expect the rollout to start in coming months, but I will not like to specifically state anything on behalf of Reliance. And I will limit my statement to that.
Okay, so any quantum of orders that we are expecting?
The rollout is huge. Everybody is expecting the rollout. The plan is in public domain. The rollout is going to be huge. Investment plans are huge. So, of course, the order rollout or the orders which we'll receive will commensurate to that.
Okay. And so just a final question. The other expenses have increased sequentially. So can we expect that purely because of QIP expenses?
No, it's not because of QIP expenses. The other expenses were there in the region of between 25 to 30 crores. Sometimes there is a forex gain element in that. Sometimes there is a forex loss element in that. There were certain reversals which we had to do in the previous quarter, and hence it is not completely comparable with the 8.42 crores in the previous quarter. The other expense trend will be anywhere between 25 to 30 crores per quarter.
Okay, sir. Understood. Thank you and all the best.
Thank you. Next question is from the line of Mr. Hiren Ved from Alchemy Capital Management. Please go ahead.
Hi, and thanks for taking my question and for stabilizing your operations this quarter. You mentioned early on that you're being very careful about taking on international projects or bidding for international projects. What are what is the minimum gross or EBITDA margin below which you will not take a project internationally?
So I would say our threshold is earlier used to be between 8 to 10%, and we are maintaining that because the market became very, very competitive in Middle East in between with the influx of Chinese players. So margin levels have dropped down. So you have seen that we have not picked up any project due to drop in margins. So we'll still consider that margins will remain minimum 8 to 10% threshold, which we had indicated earlier, and the project which we have won in Europe is in double digits that we have indicated. So we are trying to be in lower double digits with respect to international projects.
And do you still see the same level of Chinese competition in Middle Eastern and other markets?
So what we are witnessing in Middle East markets that the project volume is going to triple. Almost like this year we are expecting 10 to 15 gigawatts. And like from this quarter till end of FY25, close to between 10 to 15 gigawatt of mega projects will be there. Chinese have not delivered to the expectation of many IPPs. Project delays have happened. So the big Indian EPC players are getting a lot of traction from the IPPs in both in Saudi and UAE, Oman, everywhere. So we now expect the rationalization of contract terms and conditions as well as the margin profiles in the Middle East. So we expect it to get better, and we expect that we should be able to conclude some of the projects in Middle East in FY25.
And are there any Indian players that compete with you when you bid for these projects, now that the volumes are going to go up dramatically?
Primarily L&T would be there.
L&T?
Yeah.
Okay. And I think if we were to not look at, this year or next year, but let's say look out 2 to 3 years, is there an aspirational gross or EBITDA margin level that we would want to work towards? And what would that be?
So we will try to improve where we are right now, what we are maintaining in domestic and international market. Obviously, the aspiration of any management is to optimize the cost, build on economies of scale, make operations more efficient, and improve the gross and EBITDA margin. And that's what we'll be striving for. That's best I can say at this point of time. But with the revenue base broadening, our overhead proportion, like allocation, will be on a much wider base. So that itself will take our EBITDA margins up. And with other operational efficiencies, we expect both gross margins and EBITDA margins going up considerably.
And would it be fair to assume that from here on, whether international or domestic business that you would take on would all be negative working capital?
Yeah, that's how has been the business model traditionally, and that's what we will be targeting for. The nature of business itself is such that it becomes a negative working capital.
Got it. Thanks, and all the best.
Thank you.
Thank you. Our next question is from the line of Mr. Faisal Hawa from H.E. Hawa & Company. Please go ahead.
Sir, my first question is that, are we embarking on any kind of cost reduction? And if at all there is a cost reduction, how much can be squeezed out more? That's one. Second is, FY25, what do we expect our exact, or approximate interest outgo to be? And second is, sir, that is there any thought process within the company now to, totally avoid overseas contracts, because that is where, the variables are really too many, and that is where we have faced maximum problems in the company in the past also. So at least, or probably, we should have a much better margin to balance out the extra risk that is there from such orders.
So I'll try to answer the first two questions. As far as the strategy for overseas market, I will let Amit respond. So your first question was on overheads. Yes, definitely there is a lot of work going on internally to reduce overheads. And that is why, while last year's overheads were a much larger number, we are seeing at least a 15 to 20% reduction in overheads in the current year. Next year, the target is to reduce it even further from there. So yes, there is a concentrated effort being made to optimize overheads and to use low-cost overheads in place of front-ending high-cost overheads. So that is definitely an ongoing exercise.
Can you give a number to the reduction in overheads that we are targeting for FY25?
So FY24, let me say, while the previous year was close to 360, this time it will be somewhere between 300 to 320. Okay, I don't want to give anything very disparate, but it will be somewhere there. And next year it will be sub 300. How much we can bring it sub 300? We are just doing the final working, so before we can tell you that. That is as far as the overheads are concerned. As far as interest is concerned, if you're saying 328 crores is what remains, and if you're taking an average cost of borrowing which ranges between 9.5% to 11.5%, I think it is quite clear what will be the interest cost that will be there for FY25. If, however, we get our advances and we are very sure that they are not required for the project purposes, yes, we may deploy that towards reducing some of our overheads, or we may wait to receive some indemnity proceeds by November of this year and then reduce our loans. So we will see how most ideally that can be done. I hope I've answered your first two questions. Then I'll ask Amit to answer your third.
Yes. Yeah. So, Mr. Hava, with respect to international markets, as we are repeatedly saying, that international projects, whatever we are booking now, we are carefully examining what is the risk profile of the project, and we have a revised risk matrix. It has been developed with due deliberation along with the board and risk management committee. If the project fits or meets our risk requirement, or we are able to negotiate that, only then we are picking the project, and we are very careful about the margins also. But having said that, if you see that our majority of the order book is now comprising of the domestic orders, having said that, we cannot ignore international markets as well. So there is a lot of strength and the client relationship we have, and we have executed projects successfully and made money as well as international markets. It's not that we have only lost money. But the problem set which was there specifically was due to multiple black swan events happening at that particular point of time when those particular orders were being executed. But now the world is in a different kind of a situation. Supply chain problems and all other execution problems which arose because of the corona don't exist anymore. Having said that, we are very, very careful, and we will capitalize on only very good opportunities which can strengthen our top line and bottom line, and we are very, very careful about that. But we will continue to be present in all our traditional markets which we have been addressing, but all the order booking will be done with a lot of caution.
So actually, most smaller EPC companies in the solar space totally admit that they didn't even have the ability to do more, 1 GW projects or more than that, and they say that except for Sterling Wilson and L&T, nobody has the ability also. So I mean, with such a kind of opportunity and so many orders all coming in at one time as a tailwind, because the government has also mandated their own PSUs to approve these orders. So, I mean, would it not absolutely make sense to, have lower overheads, lower risk, and do only domestic orders for the next 3 to 4 years? Because, I mean, this is definitely looking like, a huge tailwind which will come towards you. And, I mean, even we can see clearly that, you can actually pick and choose your orders. So I really don't see the without a better reward, why take a huge risk with overseas orders?
So, Mr. Hava, you are saying it and we are actually implementing it. If you see, for last 3 years, we have not picked up even a single international order. and the focus has been on domestic market. So wherever the good opportunities which meet our objectives and company strategy, the strategy will be continuously evolved on that basis. So we cannot take a particular stand at a particular point of time. But as you said, right now the total focus is on domestic market, and we are going very, very slow on international market. Only some of our marquee clients with very good project, minimum risk profile, offers us project, and if we are able to pick up those opportunities, only then we are going for it. Otherwise, we are not booking international projects. And this is the first project this quarter which we have booked. The first order in last 3 years, and we will be fully capitalizing on domestic market. And we will also see how the project portfolio is to be balanced. If we are fully booked in India and have order book exceeds our expectations, then we might be focusing totally on Indian market. Who knows? So that's how it's an evolving strategy, and will be addressed as per the market conditions and in consultation with the board and other shareholders.
So, and one more thing is, what is the order inflow that we are targeting for calendar year 2024? And sir, would it be a right statement to say that now, given that our debt is almost clear and plus Reliance is backing, that we could actually have a situation in which we could, get as many bank guarantees as we want, as a quantum? Do we have something like a tap which is just open for us, unlimited, or that's not a right statement?
Nothing is unlimited, Mr. Hawa. Everything takes efforts. The position that we were in the last quarter. Things have substantially improved from there, and we are going to continuously work to improving it as much as we can. But there is nothing like a tap has opened and everything is available as much as we want. Sufficiently available to execute what we need to do, and we are also looking forward to build up our limits to take care of our future requirements.
So would you be able to give a number to the bank guarantees that we can open at the very maximum?
No, so first of all, are there any outstanding bank guarantees today? There are none. We have opened all the bank guarantees that are required for our projects which are there at the moment.
Mm-hmm. So, okay. So, I mean, that itself could be an advantage to us, that bank guarantees are much more freely available.
So it's always non-fund limits which is the fuel for this business. The company keeps looking forward to work on enhancement of limits to take care so that none of the projects suffer.
Okay. And sir, if you could answer on the order book that we are targeting for calendar year 2024.
2024, as you have seen, we have already booked 5,527 crores of order book. We have roughly 6 gigawatt of pipeline, which will be closed out in Q4. So we were pretty sure that, and it is a significant order book, which is to be addressed in Q4 with pipeline.
So Q4 we are expecting maximum orders.
Yeah, this we are expecting it to be quite an exciting quarter, but depends on how many contracts can close. 2 of the projects which have already been submitted, we are waiting for reverse auction with our client, and some of the bids, huge PSU tenders are to be submitted, and then we have to see how much we are able to close within this quarter. But certainly we are addressing, and then particularly bid pipeline from IPPs as well. So total bid pipeline we are addressing is 6 gigawatt, and we'll see how much we can close within this quarter.
Thank you so much, sir. Really appreciate it.
Thank you. Our next question is from the line of Mr. Kunal from DAM Capital. Please go ahead.
Yeah, hi sir. Congratulations on a good set of numbers. So just a couple of clarifications. This 6 gigawatt that we are talking of in the domestic market. Now, these are largely BOS or these are projects with modules as well, right? What is the sort of mix over here?
So this is a mix with both. Most of the private IPP pipeline is pure play BOS, but in PSU tender it's a mix of both BOS and complete EPC including modules.
Understood. And so just as a qualitative, this thing, the competitive intensity, especially with this 300 megawatt plus orders, that would be limited to the 3 or 4 players as well, right? I mean, that's what the experience is anecdotally right now.
You are right, absolutely correct. Within the order size exceeds, or the bid size exceeds 300 megawatt plus, the competitive intensity comes down, and there are very few players which are competing in that segment.
Understood. And so just on one comment on this overhead reduction, so about 320 crores odd comment, for this year as a closing, and probably attempts to even optimize that. I'm just trying to understand, on one side we are sort of in the scale-up mode, right? I mean, and I do understand the mix going towards more of domestic, less of international, and obviously the overheads over here are much lower. But, looking at this sort of order book, I mean, I'm just trying to understand what's on this 320 crores of overhead, what revenue execution can we do just from a bandwidth perspective?
So I'll give you a comparative. When we did 8,250 crores, our overheads were 220 crores. So essentially it is not all about overheads. Overheads do not exponentially rise nor fall on the base of what kind of revenue you can achieve. So it is all about your execution strength. Your overhead back-end strength is enough to take care of whatever we foresee in the foreseeable future. Of course, we are still not going to rest at that. We are still working on optimizing, as I answered to the previous question.
Understood. And so just one last bit, in terms of these performance bank guarantees, could you just help me, what exactly would be the quantum of the, percentage of the project size that goes in as a performance bank guarantee?
I will just start out. Amit can add. So typically we see 10% advance and 10% performance bank guarantees. The quantum may vary project to project. Sometimes you do get higher advance bank guarantees. Sometimes if the margin is better, there is a slightly higher performance bank guarantee that is required. But on an average, it would be 20% of bank guarantees split half and half between advance and performance. Amit, if I have missed something, you may please add.
No, you are right, Father.
Understood. So thanks a lot. This is really helpful. And
advance bank guarantee falls pretty quickly over the execution of the project.
Understood. Thanks a lot, sir. This is really helpful, and all the best.
Thank you. Ladies and gentlemen, that was the last question of the day. With that, we conclude today's conference call. On behalf of Sterling and Wilson Renewable Energy Limited, that concludes this conference. We thank you for joining us.
There are more than 20 parties in the conference.